Hi there everybody and welcome to another stock analysis video. Today I want to do a company that was actually brought up by none other than Vivek in a comment where he said, can you do an analysis video on ALGN? And then requested something else which I will get to in another video. But right now we are 100% going to be analyzing Align Technology, otherwise known as ALGN, and we're going to see if this company's fundamentals actually match the ticker price, or if it's too expensive, or is it undervalued. So with that said, let's get started with this analysis. We're going to go straight into the calculator, guys, because this company does not pay a dividend, meaning that their 5-year average free cash flow is going into themselves. Ticker symbol of ALGN, market cap of $31.6 billion, PE, guys, of 41.35. This is already pretty big, telling me, just from an earnings standpoint, that this is very, very much overvalued. Does this mean that we don't buy it? Not necessarily. We're going to take a look at other metrics and see if this company is bringing a lot to the table, or maybe if it's really underperforming when it comes to the fundamentals aspect. With the current share price of $467, pretty much telling me that this is pretty hefty right now. However, I would just like to point out something. Looking at their 1-year graph, guys, this company was at a high of around $731, which is crazy, and currently they have fallen all the way down to $400, so about $330 drop, which is huge. Now that being said though, even with that 300 plus drop, this, according to the earnings, they still need to drop some more. But we're going to take a look at exactly how much more. As I said, they do not pay a dividend, which means that their 5-year average free cash flow of $490 million going straight into themselves, pay down debt, and buy back shares. Next, let's move on to the fundamentals, starting off with the net income. 5 years ago of $231 million to 1 year ago of $772 million, which is an increase of 234%. Now, the obvious outlier here, guys, is the 2 years ago, they did a whopping $1.8 billion in their net income. Now, what caused this? Well, let's just actually take a look into where this 2 years is taken from, and well, I'll give you guys a guess as to where this one is coming from. And if you guessed because of COVID, well, congratulations, you got it right. Yes, the 2 year ago number is taken from COVID. And since this company mainly has to do with healthcare equipment, you can pretty much just tell that they did a lot of money back in 2020 because, well, there were a lot of ventilators going on and just a lot of medical equipment was needed in 2020 because of COVID. So just based off of this, if I see an outlier on the 2 year ago mark, then it's pretty much telling me that it's COVID related. Next, let's move on to the free cash flow, the lifeblood of the company. 5 years ago of $243 million to 1 year ago of $771 million, which is an increase of 218%, which, as we saw, it's a 5-year average free cash flow of $490 million. Now, ironically enough, we did not see a big increase when it came to their free cash flow 2 years ago, probably because their cap expenditures also went up. Now, 1 year ago, their capex probably went down, which probably explains why they did significantly better last year when it comes to free cash flow than the previous year. But nonetheless, aside from their 2 year mark, they're still pretty positive when it comes to the free cash flow and pretty steadily as well. Next, let's move on to the revenue. 5 years ago of $1.5 billion to 1 year ago of around $4 billion, which is an increase of 168.26%. And, well, it's normally I would think that this would be kind of steadier, I guess you could say. The 1 year ago, they just completely shot up, guys. I do not understand why they did so much more revenue 1 year ago as opposed to 2 years ago. I would have figured 2 years ago would be the outlier, but apparently not. Nonetheless, can this revenue be sustained? I don't necessarily know, because this is a big jump from $2.5 billion all the way up to 4, right? So I don't know if they'll be able to continue this. Maybe in this current year, we might get a little bit lower revenue, but nonetheless, we're still going to be on the trajectory going up. Now let's analyze whether the company is able to cover all of their debts by simulating if they were to liquidate all of their assets. Would they be able to A, cover their liabilities, and B, how much money would they have left after doing so? Currently, guys, if they were to do this, this company would still have left around $570 million in cash. Now, something to take a look at here is that not only have they been positive within the past, well, 5 years, including the current year, but they have been pretty much around the average, even even till today, right? $570 million. The highest one that I see right here is around $662 million. So even though the trend line is going down, guys, they're still fairly flat when it comes to their assets and liabilities. The average total assets is around 1.8 billion. The average liabilities are around 1.2 billion. Taking the average assets minus the average liabilities, we get around $600 million. Now let's take a look at the shares outstanding. This one right here, guys, tells you whether or not the company is diluting you as the investor. You want this number to be going down and not up. So you can see right here, Online Technologies doing pretty good. 5 years ago of 80 million shares to today of 78.7 million shares, which, you know, it's not that big of an increase. It's 1.63% on the 5-year, and on the previous to the current year, they bought back around 1/4%. Nothing major. You know, this isn't anything crazy. However, a decrease is still a decrease and is a positive metric. They are not diluting you. A small decrease is still good down the line because it will eventually begin to pile up. And lastly, we have the cash equivalents, and that's what today, guys, have around $1.1 billion in cash equivalents with around $800 million on average. Now we need to make some assumptions, low, medium, high, with 3 different factors: revenue growth, projected share buyback, and the required rate of return. For the required rate of return, I'm going to keep the same at 10% all throughout all assumptions because I want to match the S&P 500 at the best years. Now, revenue growth, guys, I'm going to get this from Seeking Alpha's growth tab right up here. Now, as you can see, the revenue growth year over year has been almost at 60%, whereas the revenue growth forward is at 33.03%. Now, this revenue growth seems completely crazy to me. My goal as an investor is to be conservative, right? Can they do 33% within the next 4 years? I don't think so. It's gonna be really, really difficult, right? At least in my opinion. Does that mean that I think that they're gonna go bad or anything like that? No, it's just, you know, we just had a pandemic, right? Are people going to continue to get sick? Yes, I'm not saying they're not, but compared to a pandemic, I just don't think 33%, 60% is founded. Therefore, my revenue growths are going to be fairly low, as you can see right here. And now, with the predicted share buyback, guys, we just saw they did around 1.65% in the past 5 years, 1/4% from previous year to the current year. So, as you can see, my predicted share buybacks are not going to be that big, mainly because we've seen from before that it's not been that big. Now, with all of that said, for the low assumption, I'm going to say 15% growth, predicted share buyback of 0.5%, we get $276.34. For the median assumption, I'm going to say a revenue growth of 18%. With a predicted share buyback of 1%, we get $305.47. And lastly, for the high assumption, we get a revenue growth of 21%, predicted share buyback of 1.5%, and this gets us around $337. Now we need to adjust for debt, guys. And the way we do this is we take the company's cash on hand and subtract the net debt. If they have more debt than cash, then this value should come down. If they have more cash than debt, then the value will go up. And as you can see, the value does go up for the low assumption to $290.38. For the median assumption, it is $319.58. And for that assumption, we get $351.17. Now, me personally, I like to add a margin of safety of 5, 10, and 15%, just so that way I can compensate for anything bad happening. The more you pay for a company today, the less returns you're going to have in the future. So you want to have a cushion, always want to have a cushion. Therefore, for the low assumption, I want to buy between around $247 all the way up to around $276. For the median assumption, I would like to buy between $271.64 to $303.60. And for my high assumption, I would like to buy between $298.50 all the way up to $333.61. Guys, the current share price is $400.67. So pretty much in every single assumption, this requires it to go down by a significant amount. Now, by how much? As you can see right here, well, given the most high assumption, this would need to fall around, what, $65 or so? Again, this really is up to you. When it comes to this kind of company, we just saw their fundamentals. It's not that bad. This isn't anything like major, right? It's not like everything is increasingly steadily going up. You do have a couple hiccups here and there. It's not consistent. So it really does depend on whether or not you want to pay a premium for this, right? This company already fell a significant amount within the past couple months. Do you want to risk it and wait for it to fall a couple more, or are you willing to pay a premium for it? Now, as you can see, based off of my assumptions, you wouldn't want to wait for this to fall down a little bit more. However, guys, these are just my assumptions. As I always say every single video, I have this calculator available for free. anybody can have it. It's in my discounted free cash flow calculator video. And we'll make a video in the next coming days on where to find all the data, because I didn't realize I didn't say where to find the data. But I'll make this video into the future. But what I am suggesting is get this calculator. I have it for free. All I'm asking for in return, guys, is like, subscribe, comment. Really does help with the algorithm. Share. We'd love to get to 500 subs by the end of the month. We're at, what, 437? We'd love to get to 500 by the end of the month. That'd be awesome. Great milestone. And, you know, make your own assumptions. I'm not telling you what to do. This is not financial advice. Just giving you the raw numbers and what I would pay for this company. All in all, when it comes to Align, I'm not really sure, guys. I mean, just the fact that they don't pay a dividend, this is already off my wheelhouse, right? However, they were $700, right? And now they're $400. But however, they still have the PE of 41, and we just saw my assumptions that it needs to fall around $65 at my rosiest assumption, right? So really is up to you on this one. I would suggest, Vivek, if you're watching this, you know, get this calculator, and which I'm pretty sure you already have, but make your own assumptions based on what you believe where this company is going in the future. I don't know much about this company. I haven't read their 8K or 10K. I highly suggest you read upon that, right? But yeah, that's just my opinion when it comes to this company. They don't pay a dividend, and their fundamentals aren't, I don't know, their fundamentals just aren't anything that impressive to me. I would like to see something a little bit more consistent and a little bit more aggressive as well. But that pretty much is it for this episode, guys. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You can follow me on my new texts as BitChute, Odyssey, and Rumble. In addition to my stock analysis videos and crypto videos, you will find exclusives as well. And in regards to Odyssey, Rumble, and YouTube, I have a Let's Play channel, link in the description below. So if you want to catch that, you can follow me there. So with that said, peace out, and be on the lookout for the next stock analysis video.